Andrew Gradman. Every time I see your name, Andrew, I want to pronounce it Grandman, but it's Gradman without the N, to speak on the One Big Beautiful Bill Act, which I know is a very hot topic of late. Just a couple of comments about Andrew's background. He's a local Angelino, attended undergraduate at Stanford University, Columbia Law School, and got a Master of Laws in Taxation from New York University. He is a certified taxation law specialist, and after working for some law firms in New York and in LA, he's a sole practitioner now as a consultant and advisor to accounting and law firms specializing in income and all types of taxes. He's a prolific writer and speaker, and I'm really looking forward to his presentation on the OBBBA, One Big Beautiful Bill Act. Thank you, Andrew, for presenting, and go ahead.
Thanks, and let's get started. So I've been doing the speaking circuit on this bill. I call it OBBBA. And I've learned a lot about how to present it from having presented it a few times. One of which is to say it's hard to present a piece of legislation coherently, especially it's about a grab bag of things for everyone. And so many of you might be coming here for a specific reason. And I always, in my presentation, start out by saying, some of you necessarily will be disappointed because I can't cover everything. And if that's you at the end, instead of leaving a bad review, send me an email and mention that that this is how we encountered each other, and I'd be happy to continue this conversation. I'm joined to getting to work with SFVBA on different levels. Jonathan Hayes has been in touch with me about writing an article about this content, so I'm happy to be able to serve this organization. Another lesson I've learned within the tax profession, we don't talk about this as a groundbreaking piece of legislation like the Tax Cuts and Jobs Act. Even that wasn't groundbreaking like the 1986 Tax Reform Act. So certain people will have their lives changed, and for many of us, it'll just be incremental changes. So don't get, and so what I think is the way to present this, maybe the third point I'll say is, some of this is presenting to you what the law is, but given what I've just said, that it's incoherent and it may not matter to many of you, it's also a kind of a civics education. I'm going to share lessons I'm learning about the way government works and this government works through the lens of this law, which may not affect your clients, but it informs you and helps you talk about tax law today. So with no further ado, there are three pieces which I think are pretty transformational for many people, and I call those my top three items. And those are code sections I must use, 168K and 179. So 168 is depreciation. K is what we call bonus depreciation or first year depreciation. And then 179 is first year expensing. And historically, these are, depreciation is supposed to represent the actual wear and tear of an object. It's supposed to represent, it's an accounting concept that as your object wears down over time, you get a deduction to reflect the actual loss in your wealth. But for decades, since the 80s, the 70s, tax policy has not sought to have depreciation serve that purpose alone. It has also been a subsidy to industry. And so you will have what they call accelerated depreciation. We use the modified accelerated cost recovery system since the 80s. Because it acknowledges the fact that its dual purpose is to reflect true wear and tear, but also to get people to buy stuff, make it cheaper to buy stuff, and drive our economy. Well, since at least the 9/11 period, and I think maybe before that, there's been an increased emphasis on the idea of really accelerating depreciation. I think after 9/11, they gave what you called 50% bonus depreciation, this big deal to drive the economy. You buy a widget and you depreciate 50% off the top right away, no questions asked. Well, the Tax Cuts and Jobs Act, made effective 2018, made that 100%. I don't think we'd ever seen 100% before. But then they had it sunset. So it was 100% in 2018, 100% in 2019, 100% in 2020, Farage is going to correct me when I get the year wrong. You're welcome to do so. But I think it was then 80% in 22, 60% in 23, 40% in 24. Whatever. Maybe I got maybe I got that off by an iteration. But we were expecting, absent a change in law, that we would go to lose all bonus depreciation. And because once you give away a tax incentive, people treat it like it's theirs forever. It was just sort of expected that, of course, this would be fixed and everyone would get what they're entitled to, which is this fake 100% bonus depreciation. And now we can go and look at, lo and behold, they did that. Congress, of course, they did that because of the sense of entitlement people had. So pre-OBBBA, 60% for property placed in service in 2024, 40% for 2025. Post-OBBBA, that remains true. But it then also becomes 100% for property acquired after January 19, 2025. This is the civics lesson part of the conversation. What happened the day after January 19, 2025? President Trump was inaugurated. So because of the Congress's need to commemorate that date with a special day, with a special tax treatment, we now get to have two methods of accounting for depreciation for property in 2025. If you had the bad judgment to buy your widget between the 1st and the 19th, perhaps you were buying it to celebrate the inauguration, but you bought it before he was actually president. You're on the no good list. It's you have to have acquired it after the 20th, on or after the 20th. Another thing I find, just this is kind of on the civic subject, but I look for loopholes, and I'd like you to see how I do that. That phrase, property acquired after, it's not and then they say, do not treat property as acquired after the date on which a written binding contract is entered into for the acquisition. That's not normally the language we use in depreciation. Usually we use a phrase called placement in service, and that has the advantage of, well, it's just, let me say that's the rule we've always used. They've introduced this new term, which they really only use in years when they change depreciation methods. And I immediately looked at that, and I'm looking forward to the fights people are going to have over what it means for a binding contract. The first thing that jumped in my mind is a lot of us buy stuff on contracts where you can return stuff later. Amazon is how I buy everything in my life, and I'm sure companies have more professional places to buy their widgets. But you can always return things. No contracts are binding, but what do they mean by binding? Every contract is, there's no such thing as a non-binding contract. It wouldn't be a contract if it wasn't binding. Do they mean the aspect that you can't give the property back? So I've been advising people that if they have property that they want to try and slip in, say that it's a Trump era purchase, maybe they can disregard their contract and say it was not binding. Do these kinds of people roll in my drawer and ask for my legal services on a daily basis? No, but I think it's fun to poke holes in this stuff. And I started with, I'll move on to the next item, but I just want to emphasize that I chose to start with bonus depreciation because whether you know it or not, it's the lifeblood of the tax system. I mean, there's so much money being made for people on that. That's why cost segregation is such a vibrant and helpful industry. Because if you go and buy a building, and on the one hand, you say it's all 39-year property, but then you find a professional who says, are you sure 30% of it could be deducted immediately? There's so much money to be had in bonus depreciation that you have to start a presentation with it. Next, I'm going to do qualified opportunity zones, which is a big area of my practice. So people will say that this law made opportunity zones permanent, and will say that they introduced a new regime called what they'll call opportunity zones 2.0. They made it permanent, but they modified it, learned some of the lessons that were before. Civics lesson, they didn't learn 95% of the lessons that were learned before. I'm always publishing and talking and complaining about the Opportunity Zone program, and I was looking forward to this bill coming out to fix all of the problems, and they just ignored what the professional community has been talking about. Instead, here's what they did. It used to be that you could no longer invest in this program after the 2020. Let me say a word about what this is. There must be one of you in here who doesn't know what the Opportunity Zone program is. The idea that Sean Parker of Napster had when he paid a big check to the Economic Innovation Group, basically created a think tank to create his idea, was that people who are very rich and own appreciated assets need to be given an incentive to sell them. Otherwise, they'll be locked in and they'll never get them into the world. So they say if you've had a capital gain, Opportunity Zones is this new fund is going to be there where you can enroll your money into equity in that fund, and then it has to be used in low-income communities, and then you get some tax incentives. And the service you've provided to the world is that you've sold your blue chip asset, and ostensibly you've put it into something that helps people. That's what the Opportunity Fund program is. So, but it was going to end, and you wouldn't be allowed to make investments after 2027. So now that's wiped out. 2026, excuse me, is no longer an ending date. What they say is on a permanent basis, you make an investment in an opportunity fund. 5 years later, you defer an amount of gain that you invest, and 5 years later, that deferral ends, and you get a 10% haircut if you've held it for that 5-year period on that gain. And now you're an owner of an opportunity fund. And then when you eventually sell it, after 10 years, any gain on the fund is also tax-free. Okay. So that's Opportunity Zones 2.0. Another change they've made to the program, it used to be that, I think it was by regulation, they said that 2048 was just the end of the program. And anyone who held it after, you would have to sell your asset before 2048. Because if you held it till 2049, you lost all your benefits. And so reasonably, Congress probably was brought to their attention, and they thought, well, we can't have this traffic jam of people selling all of their Opportunity Zone assets at the last minute. So instead they said, first of all, it's not going to be a fixed date of 2048. As everyone has a 30-year clock based on when they acquire their equity. And they also said that if you wait after the 30-year period, you're not out of luck. It's just that we freeze your tax savings to the amount of tax savings you would have had you sold at 2030, after 30 years. So that was like a brain with a lobotomy having a good idea, because like half the brain had this great idea, but the part of the brain that was missing didn't apply this to anyone who's made investments before, I believe it's December 31st, 2026. So they've solved the problem for no one unique. And every one of us who actually has an investment is still stuck with the same problem. I view this as a drafting error, and I can only imagine that when Congress comes back into session, the first thing they'll do after swearing that Congresswoman in, who is waiting to be sworn in, is that they'll pass the legislation fixing this, because this is just purely an error. Next, so there's a few other things you can say about qualified opportunity zones. They're going to create a rural opportunity zone concept, so that instead of having 10% of your gain forgiven, it'll be 30%. I question how valuable that incentive will be. I think the draw to the Opportunity Zone project was getting assets that really explode in value, and people are really drawn to high value real estate areas. So there are opportunity zones all around the country. They're scattered around, and then real estate professionals put on their thinking caps, and they find the ones that are least deserving of subsidy. They find the ones that already have tremendous trajectories to be economically successful, and they only buy there. And I respect the fact that by adding the rural opportunity zone concept, Congress is trying to say, oops, let's try and see if we can get people to invest in deserving areas, more deserving areas that are being overlooked. But it's the structure of the incentive is to drive people toward high value, high turn areas. So that's kind of a cosmetic fix, I think. And look, I'm not like next week, I'm going to be speaking on a panel with the Brookings Institute and Urban Institute on this subject of what are the lessons that the Opportunity Zone program should be learning, and what should governors be learning when they select their zones. And I'm going to tell you my view is that there are no cosmetic fixes to this program. It's not structured to solve the problem it claims to solve. So thank you for the 30% benefit for rural opportunity zones. We'll put that in our pocket, but I don't see that promoting the values of the program in the way it might have been intended. Qualified small business stock. Okay, I I have said the following. I've said if you go to a tax lawyer party, go to the ABA tax section and just go to walk around and poll people and ask them why we have a tax incentive for qualified small business stock. No one will be able to give an answer. I've read articles which express it in sort of like the terms that you would expect from like a congressman talking points, but I think a lot of us don't get why we have this, but we have it. So forget about what it's for and just think about what it's good for your client. The idea is uh, you got startup companies, let's say, and if they're in corporate form, and startup means that their assets, the gross value of their assets, it used to be doesn't exceed $50 million. This amends at 75 adjusted for inflation. That's how you think about startup. It's 75 million plus inflation. Um, Someone acquires stock in that company, holds it for 5 years. If the company is not a specified service to your business, meaning it's not a law firm or an engineering firm or a firm whose service business is on the talent or the reputation of the person providing the services, you got to clear out a company of ineligible businesses left over. There's a lot of tech firms and others, manufacturing firms as well. The benefit is that when a person holds for 5 years and goes to sell, under the old law, that person gets exclusion of, generically, they'll get a $10 million exclusion. But if they engineer it correctly, they can get up to $500 million excluded on the sale of their company, which is just the law. It's correct. It's a correct statement of the law. But I'm always embarrassed when I tell that to clients because I just can't believe that. But there is a lot of good engineering going on in the QSBS world, a lot of wonderful, smart service providers who are helping people to structure their companies to sell and exclude $500 million of gain per individual. Perhaps you have children and you get stock into their hands. Those smart lawyers are also excluding the gain from their hands. Anyway, I've so far introduced the old law. What the new law does, it says that wasn't generous enough. And so it adds a few flavors. One thing I've already said is that the definition of a small business whose stock can be eligible for this at issuance is now 75 million plus inflation. It also creates. I said before that you have to hold the stock for 5 years. Now, under the old rule, if you sold it at 4 years, if you and you want tax benefits, you have to do a rollover into other qualified small business stock. It's like a 1031 exchange. You know this from real property and real property. Well, they've got that for small business stock as well. You would have to sell your company and go, okay, I got 100 and it's actually not 180 days. It's something similar to buy some other company. And so the clients coming to you saying like, I'm going to create a fake shell company and it's going to own my cats. And can I do that? And then you have to, well, a case by case basis, you decide whether it's a good company. But now there's another option for those people. Um, if that sale comes at 4 years, you say, look, you you can get 75% of your gain will be excluded. Maybe that's what you want to do. Just take the check, go with it. And if you sell it 3 years, the new law says that 50% of your gain will be excluded. And so I think what's not talked about, but I think people should appreciate if they're going to go in the weeds on this, is that there when when the qualified small business stock rules exclude a percentage of your gain, the percent that's not excluded is taxed at a higher rate. It's such a weird way of drafting the law, but this is expressed in section 1 of the code. And when they define the 28% rate subjects, it's collectibles like Picasso's and other and Magic the Gathering cards, and it's the portion of qualified business stock whose gain is not excluded by section 1202. So you're trying to do your math, thinking, okay, 50% of my gains excluded, so federal 20% federal rate, so 50% included and 50% at, it's not 20, it's 28%. So it's just a little awkwardness that I like, if you like disappointing people, tell them this when they think they know how much savings they're getting. So one question that people have a lot, and certainly it's been written about in tax notes articles, and I've had people ask me is, how can I contrive to make my old stock look like it qualifies under these new rules? I want to, I want to, I had a guy be like, for example, guys like, I was issued stock in April, and then this law passed. How about I have my stock be redeemed by the company and then they issue me new stock? Not only is that an awful idea, but no one has yet identified a way that you can transmogrify your old regime qualified small business stock into new regime qualified business stock. And people who try to do it, gentlemen, sorry, really injuring themselves. If that person did what he did, there's rules against people who have their stock redeemed. Um, and I just want to the moral of the story, the simple moral of the story is you don't convert old regime QSBS into new regime QSBS. You just be grateful for what you have. So I call those my big three items in there are many other items that may be of varying level of interest to you. I want to like to start with my blooper reel. This is going to be the subject of an article that I'm going to be writing in the next week, but I think these are funny and mostly from a civics lesson perspective. Just to do a flavor, this is sort of simple, not going to affect any of you. There's the CHIPS Act, the Advanced Manufacturing and Investment Credit for manufacturers of semiconductors. So you know that this law just did a whole number on all the tax credits for anything, especially green tax credits. But how they affected the chips, they increased this credit from 25% to 30%, but they did it prospectively. They had there be a 6-month gap. So to my mind, that creates an incentive to not invest in semiconductor facilities for the next 6 months. And I actually was able to reach out to a semiconductor tax lawyer who wrote an article in Tax Notes. And I asked him, like, do you agree with my analysis? He said yes. He also agreed that on the margin, this may or may not affect that many actual factories, but it just gives you a sense of the kind of shenanigans you get when bills are written quickly. This is not good tax policy. Um, um, my actual favorite one, which I wrote about in this article shown in the footnote, some of you may have heard that there's a new provision for I call full school vouchers, and it's the idea is that every person will be they're going to create I think it's called a qualified scholarship fund. It's a category of 501c3. And once a state puts a blessing that an entity is in that category of 501c3, then you can make donations to those 501c3s. And instead of just being the normal triple deduction, which excludes, say, 30% of income, you get a $30 value, these stations will get a dollar for dollar exclusion. So that's you never get a $1 for dollar credit in the code for anything as easy as just writing a check somewhere. And now these organizations then take their hoard of money and use them to give scholarships, and that's why they call it a federal voucher program, because it's a way of continuing voucher programs that are done currently in local areas, but it's now been blessed federally. People who are opposed to vouchers are just terrified. I mean, I have been in touch with kind of people that or the organization, I don't have to characterize it, but you can imagine the people who are just terrified at what this is going to do to local schools. But I look at it as the tax loophole angle, which is that I think that the budget office, Congressional Budget Office and Joint Committee on Taxation, they were in such a rush that they didn't see a change in the law that occurred from one day to another, and then the law was passed, such that they scored this bill at $3 billion. But my thinking is, if every taxpayer is basically given the authority to go to Treasury and say, take $1,000 of my dollars that you have and give them to something else, anything else. It may be a 501c3 in your backyard that serves your religious group. It may be a 501c3 in Montana that serves your religious group. It may be, but just the option of being, you have control to take money out of the fisc and put it into one of these organizations that may from values. Not only do I think everyone's going to want to do this, but since every one of these organizations can use 10% of their funds on administration, I think every one of us may have people knocking their doors constantly and, hey, did you remember to give your $1,000 to a fund? Because if you haven't, to mine. Like, we're going to be seeing advertisements for people because it's free money. And so I estimate that the budget loss of this is more like not 3 billion, but 150 billion, leading to some number of trillions. I estimated that this would increase the bottom line cost of the Tax Cuts and Jobs Act, excuse me, of the OBBBA by 33% over its lifetime. Now, I've been in touch with people. They haven't said like, Andrew, you're blatantly wrong, but they have sort of politely said, well, we're going to see. So you know what? We're going to see. This will come into effect in a year and a half, and then if I'm wrong, I'll eat my words. But I don't see a logical reason why I'm wrong. So anyway, that's an illustration of the bloopers. I'm not going to spend all day on bloopers because you all have clients to serve. So let's talk about other things which have really material impacts on you and your clients. I think sometimes the most trivial changes can be the most consequential changes. These things that no longer sunset. Let's go through some of these. There's no sunset anymore on the top 30% top individual rate. Remember, it used to be 39.6, and it goes to 37. That was supposed to sunset next year. That's forever. I mean, that's just a rate, and it's just a small rate. But I mean, just think about what that does to, you get a little more take-home money if you're very, very rich, and it reduces a lot of the or increases the size of the deficit. There's no sunset on the increased standard deduction, which was a big aspect of the Tax Cuts and Jobs Act. And to me, an important way of thinking about the increased standard deduction is number of people it incentivizes to not be itemizers, because so much of tax policy is conducted in the itemized deductions. You are meant to be you write in that you're like, okay, charitable deduction. Let's get people to give deductions to this kind of charity, public charities, rather than to private foundations, and yada yada yada. You know, all that doesn't matter if people are on the itemized, or if people are standard deduction. Another one that affects every one of us or our friends is a home interest mortgage deduction. We all know people to buy their home and they're to learn that they'll be able to deduct the interest until they're told, well, you're a standard deduction person, and even after that, when we do the math for you, you're still going to be standard deduction. So the marginal benefit of being of this notion of deducting interest on your home is zero. So it's lovely that we have the standard deduction, but it's like a bright light that blinds, it washes out all of the subtle incentives that are built into the itemized deductions. As I'm in the home market now, and I certainly many of my friends are. That to me is an example. Charitable is a big one. The charitable industry really suffered when they increased the standard deduction for this. Another change in the OBBBA is that they're going to create above the line small amount of charitable deduction will be above the line. Above the line things mean you take them regardless whether you do take the standard deduction or you itemize. And so this was an idea that we saw recently for the first time under the CARES Act. I think it was one of these issues where coronavirus shut down a lot of financial life, charities were suffering. And I think with the intention of helping charities, the CARES Act included a provision that said $300 or $600 if you're married would be above the line of charities. Now the OBBBA makes it, let me do a full text search so I don't do this wrong, 2,000, 1,000 for an individual and 2,000 if you're married. I just want to find the text for that. Well, I'm not find it, so maybe I'm wrong, but I'm right. So all right, I'm not going to waste your time. So but what I think is interesting is that they increase it starting next year. It's sort of like the CHIPS Act thing, right? I mean, why would you create this incentive and then delay it? But what I find extra frustrating about it is that, like, if I just gave this, I pay very close attention to effective dates. A lot of people don't. A lot of the press is not paying close to effective dates. That's where lives get ruined. Is when I say that they're creating this $1,000 above the line deduction that you give to charity, and so you get off this call and you write a check for 1,000 to charity, and then you find out from your return preparer it's going to be effective next. What you just did is you're not going to be able to deduct that because you're a standard deduction person. So that's going to be in the blooper reel. That's bad policy. But at least I like the idea that starting next year, $1,000 will be above the line deduction to charity, regardless whether you're an itemizer. That's nice for charities. So going through this list of provisions which will no longer sunset, for the interesting ones. No sunset on the disallowance of miscellaneous itemized deductions. Let's talk about that because that actually impacts you and your clients in concrete ways. It's hard to summarize what a miscellaneous itemized deduction is, but I want to give an example, which I think is painful for a lot of people. The attorney's fees that you may be paying on a lot of litigation. I represent folks and they ask for advice on how to characterize the settlements. And attorney's fees under the law as it is now and as it will be going forward, my goal is to make those attorney's fees be above the line in some fashion, sort of characterize them as meeting with one of the definitions. Like, was it involved in a loss of property or was involved in a discrimination case or an employment case? Those are all wonderful cases to deduct your attorney's fees. But if you don't get that and you're not lucky in how your case is structured, you don't to deduct attorney because those are miscellaneous itemized deductions. It's I'm surprised that Congress chose to continue this, but I guess there are a lot of forces at work in deciding which benefits to include and not include. And so this is a kind of suffering that our clients are going to continue to have to suffer through when they settle their litigation. So another important one, the state and local tax cap. So I think you all appreciate this on some level, and I don't want to belabor the background, but it used to be that the act of paying taxes to California was deductible regardless whether it was personal in nature or not. So classically, your house, that's a personal consumption asset. Usually consumption is not deductible, but it was a tax, and they say taxes are deductible. So you deduct that. And so those of us in California, New York, we're subsidized on our taxes. I mean, I say it that way. I understand both sides of the argument. And then they capped that at $10,000, leading to a lot of shenanigans by California, New York to try and get around that. One of that is to have a pass-through entity tax, is to sort of say, characterize this as not a business. If you can characterize it as a business tax owed by your partnership. And so California went out of its way to allow you to claim that a lot of these taxes were owed by your partnership. And in fact, the week before the OBBBA passed, California extended its PTET legislation, anticipating the SALT cap continuing. So our old PTET, pass-through entity tax rules, continue to be in place. They have has made them a little, because a lot of people lost out on this by not being able to make the deadline, by failing to pay the prepayment tax by what I think is the June deadline of the previous year. The concept was under the old law, if you didn't pay a prepayment, then you were not eligible to claim the thing the next year. A lot of people were losing out of the benefit for that. And so they have I would call a graduated system. Instead of a cliff where you don't pay by the deadline and you lose out, they just sort of penalize you for that late payment, but it still is worthwhile to claim it, and you can claim it, and you can still claim your tax benefit. So that's a for those of you who've had people crying into your office saying, I didn't know about the prepayment of tax that was necessary for the PTET. In the future, it's going to be a little easier. Those people have a somewhat of a remedy. Anyway, going back to the federal, back to our hero, the United States, um, they're for the 4 years of for the rest of the Trump administration, the limit goes up to $40,000 from 10,000. Although it'll phase out for people with a gross adjusted gross income of 500,000. And then when he gets on the helicopter and flies into the distance, the salt cap comes back down um, to what it is now. So we'll see how future policy, whether that law continues the way it is. But we do get a more generous salt cap for the next 4 years, and that's wonderful savings for many of our clients. Um, let's see. Um, I'm gonna, in case it wasn't clear, folks, you can chime in with questions. I won't mind. I can't really read the comments if you're commenting. This is recorded, so we want to be polite to the many people who may listen to this in the future. But I would welcome interruption if someone wished to just interrupt me. So I'm going to next talk about the changes to the charitable contribution rules. And it's interesting. It's a lot of bad drafting here. A lot of articles have been written trying to parse what was intended, but the gist of it is clear. I've already expressed, and oh, finally, that's why my full text didn't do it. I didn't put commas in. I've already expressed this above the line deduction, which is little Romanet 2 on the screen. But now another concept is that the Tax Cuts and Jobs Act had increased the AGI limit. So the idea of the AGI limit in the charitable deduction is that you're never going to write a check to charity and owe no tax for that year. They don't want you to do that. There's a percentage of your tax which you must owe, and it depends on the nature of the deduction of who your donee is and things like that. And so the most favorable form prior to the Tax Cuts and Jobs Act was if you wrote a check of cash to a public charity. They called those 50% charity because that was how it was. And now the cruelty is if you write or if it was actually you get that treatment regardless whether it was cash or property. You get the same treatment. Tax Cuts and Jobs Act, they say if it's cash, it's not a 50% AGI limit, it's a 60% AGI limit, which I find frustrating because the phrase 50% charity still sticks. So if you give cash to a 50% charity, you get a 60% AGI limit. We need better words. It's just a vocabulary problem. But that's my problem, not yours. So the point is that the Tax Cuts and Jobs Act gave us this, but it was going to sunset. They made that permanent. So keep writing your checks of cash to public charities. And then they did a few other things. One of which is that they created a floor below which you have to give a certain amount of money to charity to have your deduction count. And for individuals, you have to give 0.5% of, I think it's your adjusted gross income. And for corporations, it's 1%. And I think the way this is intended to work is if you have a pattern of giving every year, what they do is once you give in excess that amount, if you fall below it, you're screwed. But if you give $1 in excess of that amount, then it's carried over to the next year. And if you have a routine of making annual donations, then it'll just get carried over. You're hit in the first year, but in every subsequent year, because it's carried over, you continue with your routine of giving, and you are deemed to have satisfied that 1% floor or 0.5% floor. So the nicest thing to say about this is it's thoughtfully structured to encourage people to have routines of giving. It's probably also thoughtfully structured to the amount of tax that people have. But it is the law, and it's going to influence the amount of deduction that people get, and it's a little bit of a subtle calculation that you would do deciding what that deduction is. So we've got what's fun. Here's a fun one. Oh, you know what? Let me. I have a few ones that go to the policy more than the people walking in your door idea. One of them is sort of the number of employee benefits and other benefits which are now going to be limited to people with social security numbers. That's not fun. Um, my understanding from looking into this is that how do you get a social security number? I think it's four ways. You're a citizen, you're a green card holder, you can be DACA, deferred action on arrivals. You get a social, and there's a fourth way that I'm forgetting. And and so they've limited a number of benefits to those people. One of which here I have a whole thing on this SSN requirements. So what are the provisions they're doing this for? So there's a deduction for seniors that you may have heard about. That's been characterized as no tax on Social Security for seniors, which is not what it is. It is an increased deduction for seniors. You have to have a Social Security number to enjoy that. The child tax credit is one of these things. Not only does the child have to have a Social Security number, which is maybe not so hard if the child was born in the United States and under current law, they're a citizen and then they get social, but the parent also has a social. And I mean, these are, you can the obvious policy debates over this are expressed in the legislative history. You've got the the Republican section of the legislative history. It's expressed, the majority section saying we don't want to give this money to people who are undeserving people, and the minority side saying this is child tax credit. This is for families that are trying to make it through life. Like this was meant to be a welfare program. Uh, we don't ask if children are deserving. So that's the debate, which I'm not taking any side. That is expressed in the legislative history. More of these provisions that are now keyed to Social Security numbers. Discharge of student loans on the death or permanent disability. This was permanent, but they're saying only if you have a Social Security number. If you don't, and you have student loans and you die, your heirs will inherit your debt. No tax on tips is you have to have a Social Security number. I can only imagine what fraction of people who are in the tipped economy don't have a Social Security number, and they don't get to enjoy this. Same with the no tax on overtime, the Trump account, and also eligibility for the American Opportunity Credit and Lifetime Learning Credit. So, see, I wrote it here: citizens, green card, work visa, and DACA. Those are Social Security numbers. Everyone else gets an ITIN, which is used for taxes, but it's not a Social Security number. So that's a civics lesson I wanted to share, and maybe something on a lighter side is with respect to wagering losses. This is interesting because I think you may have heard about this, but there's so many interesting nuances. You may have heard that gambling losses are going to be limited to 90%. But what does that mean, and how does that work? I wrote a letter to tax notes. It's called "To Help Gambling Addicts Ditch the 90% Cap," because I was responding to so Mike Pence has this nonprofit action organization, which was expressing that this change, by limiting the deduction for gambling, you would reduce the amount of gambling. You would reduce the incentive to gamble. But when you look at but here, let's look at how this actually works. So as I expressed here on the page, there are three classes of gamblers. There's the non-professionals, who are also non-itemizers. They claim the standard deduction. Then there are the non-professionals who are itemizers. And then there's this weird class of people who are like professional gamblers. So I think most people are non-itemizers. They claim the standard deduction, and most people are non-professionals. So let's how they do. As I say here, they get the worst treatment. Because they take the standard deduction, they get no deduction for their losses in gambling, but they're taxed on their income. So it's this weird ratchet. You have a day, you have an experience in gambling that goes up, down, up, down, up, down. Every up is taxed, every down is not taxed. The exception is that we use what's called the session method of accounting. We acknowledge that, like, when you're in the casino for a day, we're not going to track every up and down. We'll treat your net number at the end of the day as either an up or down without regard to the events that led to it. And so within a session, you do get the benefit of your losses. If you go up and down, you're like, okay, the down, at least it offset my losses. And so the way I express this for these people is, if you are in a session and you're down, you know that if you walk out that day, you're going to walk out with a net loss. It's going to be useless to you for tax purposes. So that's not good. But if you continue to gamble and you're addicted to gambling, so you expect to win, you think, well, I should gamble now because then my winnings will be offset by my losses. So that individual who's deciding whether to go home and walk away from the table or stay and gamble, this law encourages him to stay at the table. There's a few similar ways you could express that for the non-professional itemizers and the professionals, but I just found that particular point, and that's why to help gambling addicts ditch the 90% cap. That's sort of how I express that. It's a weird, perverse incentive to gamble. What else we got? You know what? A really big one that I know we're all expecting you to talk about is the estate tax exclusion. It was a big deal that they made permanent. The math is the timing is subtle. Next year it's going to become 15 million exclusion, and it'll increase with inflation. But basically, what they're basically doing is taking what we have now and making it permanent. I think that it's sort of obvious on some level what that says for planning is that we're not going to be focusing on getting assets out of the estate for many people anymore. We're going to be focusing on keeping assets in the estate to enjoy the step up in basis at death. Folks who are immersed in estate planning will have maybe more subtle things to say than that, I'm sure. But I think that's probably the headline that one would say. But the other headline from a civics perspective is that I'm so angry at Congress for causing our clients to spend so much money on our legal services these last 2 years, on getting assets out of the estate in anticipation of the end of the expanded TCJA deadline, only to have them say, you know what, it's not a race anymore. Take your sweet time, you know. And I don't know how many of our clients appreciate how angry they should be. Not at us. We did the right thing. We did the right thing in the light of the incentives that were provided by Congress. But that how angry they should be at Congress for tricking them into buying so many slats. You know, spousal lifetime access trust, the trust that was supposed to artificially get assets out of your estate while letting you keep them in your life. Well, people are stuck with their slats, and they didn't need them. I mean, they're lovely products, so they serve other purposes. But I feel bad for people, but that's not on the lawyer, that's on Congress. Let's see, I started at sort of a little after. Would someone on the management team remind me how much time I have left?
You have 10 minutes. Okay, so 10 more minutes, and fine if you go over 2.
I would like to. Okay, I can keep talking, but I would really, and I will keep talking, but I would really encourage people with questions to say them now. Even if they're bad questions, because now's the time. But while I'm waiting for you to interrupt me, I'll say a few other things. So let's talk about tax reporting forms. I thought this would be great. So the threshold for 99 used to be $600. That was increased in 1948 when it used to be $500. And so it's been $600 for 80 years. And so you could say correctly that if you adjust that for inflation from $1948, it was basically $8,000 in 1948. And now it's in adjusted dollars. Now it's 600. So you might say, well, that's due for a fix. I don't think that's actually the right way of thinking about it, because back then you had to ride on a horse, and then you had to send a horse to the IRS. And of course, it was expensive to do that because you use a whole horse. Now everything's done. We don't need automatically. So the cost of these clients is really small. And the idea that as a policy matter we would try to maintain this level, I think is wrong-headed. but this is the law. So they've increased it from 600 to 2,000, and it'll be adjusted for inflation. The other thing that they've done is on a thing called 1099-K. This reports payments from third-party settlement organizations. That's payments from the PayPals and the Venmos of the world. And there's been a fight going on in Congress and in Treasury for the last 5 years. Congress had said, I think in 2022, they wanted to lower this to 600 as the threshold. This was the American Rescue Plan Act. Treasury basically said, we can't, it's too hard, give us time, and they dragged their feet forever. And the OBBBA Act says, we're reversing that and going back to the old regime. Threshold of reporting of 20,000 and only when the aggregate number of transactions exceeds 200. And so I'll just to illustrate, I think as I write here, this affects those of us who use Clio or Practice Panther to do our legal work. We're getting 1099. That they are a third party settlement organization, or they use one. So I think many of us are getting 1099, get a 1099-K from Clio. And under this law, maybe I'll be less likely to get it, depending on how many transactions are settled through Clio. Congress isn't worried about me. They're worried about Uber drivers. I find that this increase is just basically an invitation for people to not pay taxes, especially when you combine it with no tax on tips. I mean, somebody asked me, what's the effect of no tax on tips? And I said, well, if people, to the extent people are already getting paid through 1099-Ks, through, say, Patreon or Venmo or whatnot, they're already not paying their tax. They're not reporting it legally. So concretely, now you're making it legal to do what they were already doing illegally. So, reporting is going to be a lot more loosey-goosey, and the CPAs and return preparers in the room perhaps can sympathize. What else can I regale you with? No. I'm not being interrupted by you with questions. I will conclude. Let me conclude. I have said that I don't think this law is no tax on tips. No, I'm going to do no tax on tips. This is fun. This is all going on right now. They did a lousy job with that. Here's a blooper. It's a $25,000 cap. So $25,000 of your income can be tax-free from tips if you're single. If you get married and you're married filing jointly, it's still $25,000 for the married unit. So there's a marriage penalty in no tax on tips. And these people, the tipped workers, that's what they really need. That when they get married, they need to have a hit like that. I think that's clearly understood as a mistake, but in the regulations, Treasury's bound to do what Congress says to do. So Treasury doesn't get to say, well, they made a mistake, so we're going to ignore it. The proposed regulations, which came out last month, say, hey, we see the marriage penalty there, and it is going to be enforced. Another interesting thing is that the statute has passed. So I mentioned the phrase specialized service trades or businesses. This is language that you see in the qualified small business stock universe. Those are the companies that are not eligible for qualified small business stock. That gets reproduced in many code sections, and it was reproduced here, which is to say those people also don't get to enjoy no tax on tips. That list includes performing arts. So if you were a performing arts corporation and a shareholder sells his stock, he doesn't get QSBS. And if you're a performing artist and you get tips, you don't get to exclude the tips. That's what they're saying. They do this weird thing where they make a different rule depending on whether you're self-employed or employed. If you're an employee, we don't look to the service you're providing. We look to the service your employer provides. And the example given is if you're a bartender, bartender's not a specialized service trade. That should be you would think the tips are excludable, but no, lo and behold, you are a bartender who works at a theater, which does shows. Well, you are out of luck. You should have worked for a bar, because performing arts is not a good category. I just was talking with someone who's an employee of the tax notes company today, tax analysts. We had a conversation about this, and I was I raised my voice to express how I feel about that. They didn't put a lot of thought into it. I mean, another thing that they've got on they publish a list of employees who they call tippable, traditionally employees, and they include influencers on YouTube, because traditionally means before December 31st, 2024. So before 2024 is the land of tradition. And they are traditionally tipped. They get tipped on a Patreon. So they include them in that list. But like influencer, by definition, you can't imagine an influencer who's not in the definition of a specified small trade or business, in that definition incorporates people whose reputation or skill. Like, isn't that, how could it be? And I come up with the hypo, like maybe if you're an influencer who's paid a W-2 Johnson & Johnson to pretend that you like their toothpaste, I guess you could say that you are, you know, you should look at the toothpaste company who employs me. So maybe we'll see more influencers going on W-2s. And with that charming thought, which I never really thought before, I guess I could wrap this up and invite anyone to say anything they want now.
Thank you. That was a wealth of information. Harach, if you have any comments, also your MCLE certificates will be sent hopefully later today. So thank you all. Andrew, great presentation. And Harach, I'm going to give you back the floor.
Yeah. Sadly, I'm not going to be able to get my clients to send me their tips my way and be able to exclude that, unfortunately. I guess none of us we're going to be able to. Thank you, Andrew, for this informative presentation. Of course, the handout that you have, it's a great resource for everyone. You have Andrew's contact information. You're welcome to reach out to him with questions, new business opportunities.
Since you said it, sorry to interrupt you. Let me emphasize that the handout that was sent out is a track changes version of the entire statute. You won't be able to find it anywhere else. I did that manually. I gave up a week of my life. And I maintain the same document on my website. I think if you do a full text search for red lines, download the latest version of that. And it's cool to know. So, I'm done talking.
Thank you. And Andrew, as he mentioned, has a lot of resources on his website. A lot of the articles that he wrote are available for you to review and peruse. Thank you, everyone, for attending. And don't forget the installation galas on November 13th. And we'll see you back here on November, I believe it's the 18th, the third
November
Tuesday.
18th.
The
Yes.
third Tuesday of November for the San Fernando Valley Bar Association's Taxation Law Section webinar, where I invited Girat Gobinas to talk about the foreign gift tax reporting and foreign estate tax planning issues. Thank you, everybody. Have a good afternoon, and thank you very much, Andrew, for the presentation.
Yes, thank you all. Great presentation.
Thank you, everyone.